Hello, ladies and gentlemen. Welcome to another episode of With All Due Respect. Today, I have the opportunity to invite Raghav. He's from Seven Lending. It's an alternative lending, not a freaking out as it's a private, purely private. That's what we're going to talk in detail today. How Raghav and how his and some of my clients also. So, welcome, Raghav.
Thank you.
Welcome to the conference. Thank you. Thanks. I know you're a busy person, so I really appreciate you squeezing us in the day and on a short notice and coming up here to tell a little more about the alternate banking, what it is all about, and how does it work in the real estate business. So, straight coming to the point here is, Raghav, I come across with the people, especially in this market. People are stuck. Some people, for some reason, they purchase the property, their mortgage is not getting in place now, and they are stuck. So, rather than losing on deposit and getting a fear of if the seller is going to be suing them for all the losses, how your banking or how your brokerage can help them to save that deal and still able to make some money out of it later, maybe if you can put some light on that.
Absolutely. I think, the big taboo in the industry is if you're not getting a mortgage from a bank, you're screwed. That's what people think.
Correct.
It's like, if it's not a bank, I'm losing my deposit. I got to go running. I got to scramble money from family, and it's the end of the world. But that is not the case, as you and I have seen in so many situations.
100%. Yes.
So, in general, there's so many other scenarios outside of bank lending. There is an alternate A lending, which is popularly also known as B lending. And then there is a private lending aspect.
So I stop it here because a lot of people don't understand it when Raghav said B lending and private lending. So there's a difference between a B lending and a private lending. Before we go too far, can you just explain in the brief, what is B lending? How is it different from, or for that matter, what are A lenders?
Absolutely.
Which are the banks are the A lenders you call it?
Yeah, so the big banks of Canada typically, CIBC, TD, Scotia, etc. They are typically considered A lenders.
Okay.
And then there is B lenders. Now, B lenders itself are also big financial institutions. They have big assets. Sometimes they are funded directly or indirectly by bank, they're in itself financial institutions. But you may not hear their name every day.
Yes.
But these are companies which lend with really good rates. But because they specialize with this, they give you access to more other products.
And is that the same banks we are talking about who not only charging you interest-only payments, but there is a principal also in there, right?
Correct.
That's
so they typically work the same way.
Same way. Only there will be
over 25, 30 years.
There will be any interest difference between the bank and the B lender?
Yeah. Typically, there's only a 0.5% to 1% difference.
Okay.
Like right now in this market, a bank's fixed rate is probably between 4.8 to 5.2%.
Right.
What you consider a Scotia, TD, or an A bank.
Yes.
With B lending, we're seeing rates close to 6%.
Okay.
But in that just a 1% difference, they have guidelines which can make such a big difference in you getting approved for your mortgage that it's amazing.
So can you give me a live example, like instead of real example is I'm a buyer. Okay. I'm a self-employed. Most of the self-employed doesn't file the income, or the personal income is not that, because most of the money is in the company itself, right?
Yeah.
We don't take out the money out of the company for whatever reasons is it. And getting a finances from the bank is pretty hard because they don't look into the company side. They look into your personal incomes. Absolutely. And then they're stuck. So how come the B lender can come into the picture and help in that case?
Absolutely.
Or can they do anything on differently?
Definitely. And my clients love me for this. So this applies to, business owners, Uber drivers, like so many different scenarios.
Yes.
Owner operator truck drivers.
Yeah.
So typically if you go to a bank, they'll look at 2 years of bank statements or 2 years of personal net income you report from the business. In most cases, a business will show less net income because you're writing off more expenses or you're taking money in salaries or so on and so forth, right? However, in a B lending scenario, I'll give you an example. I had a client who owns a popular restaurant. Okay. They have really good high sales and deposits, but their personal net income is only 70 or 80,000. 70 to 80 for themselves, for the husband, and 70 to 80 for the wife, which let's say is an annual income of 150 to 160. Now, just based on this income, the bank will probably qualify them for a mortgage of 700 to 800,000, depending on various factors. Now, if the same client was to go to an alternate lender, right? What we can do is we can just look at their 3 to 6 months of bank statements, see the income, less expenses, and use that income. In this case, when they're showing an annual income of 70,000, their monthly revenue might be 50, 60 grand. Their expenses might be 20, 30,000. And those statements will show an income of 30,000, which almost doubles up their annual income. So they'll qualify for almost double the mortgage.
For easy numbers, let's say my personal income is, and for the viewers also, and I'm going to try to elaborate in an easy language, and correct me if I'm wrong somewhere, Raghav is going to be, if I'm a buyer, my personal income is 50K annually. I'm showing it on my NOA, notice assessment, 50K. But I'm a businessman. I'm having a deposit of $50,000 every month into my account. So if we take a 3 months average, it's going to be 150, correct?
Less expenses.
Yes, less expenses. Let's take a net number, 50K deposits, and there's no expenses on that side, just to run scenario here. So my income is going to be counted $150,000, whereas my personal income is showing $50,000. So that's where my mortgage is going to be much easy to qualify if I go into the B lender.
More or less, yes. I mean, there's some adjustments to how much income we'll use, all that stuff.
Right.
But yes, and you don't. It doesn't matter what you showed in your taxes 2 years before.
Correct.
All that matters is what your last 3 to 6 months of bank statements look like. Yeah. Assuming everything else is good.
So, guys, people also who are watching here have to understand it. There's no need to get panic or freak out if it is not a bank. Rather than not doing it, buying a real estate. I'm not saying it. Don't just go to the B lender is the first option. Try your bank side. But if it is not that side, we are into the business, or you are as an investor into the business where you wanted to make money. You're not buying a principal home. If you wanted as an investor making money, you look into the bigger picture. The difference between the B lender and the A lender is only 1% or so. And that interest is also, I'm not an accountant, but what I can experience from my personal investments too is write-off. You can write it off, that interest, if you're paying extra interest. That can be write-off. Yes, if it is if it's an investment property, if it is a rental property, I'm getting my rental as an income too. But simultaneously, the interest, if I'm paying extra, I can write that off too extra, because interest you can write it off on the principal and payments on it.
And the other thing is, like, just to look at the big picture. If I personally have to go, I'll go in my situation more for alternate or B lenders.
Yeah.
And the reason I'm comfortable with this is, like, let's say if I have a choice between showing 150,000 net income or 50,000 net income, of course I'll choose lower because that's a significant difference in tax.
100%.
And even if I pay 1 or 2% more, I'm going to make more than 1 or 2% on a property.
Yeah, you're not buying a real estate just to make a profit of 1% or 2%.
Yeah, I'll put in a GIC if I want
exactly.
to do that.
That's what I tell people also. Like, we are not in a game where we're making 2% profit on it. Even though you're going to be paying 2% extra or 1% extra, whatever extra you're paying it to the bank, it's still going to be less than what you're going to be making on it. On average, from last 10 years, real estate has been okay. If we even exclude last 2 years, because the last 2 years were super crazy, but even if we exclude those also, on average, 15% is a very conservative approach to saying that appreciation of the property going to be. Every 2 to 3 years we see it, the 15% of the growth. So compared to 5% interest we are giving it, we're still making money on it.
Absolutely.
And it's a bank's money we are paying. That's how you're making money. That's what the people makes mistake is then, we buying a house for $1 million. Yes, you have a liability of $1 million, but you didn't put $1 million in there.
Yeah.
You put only $200,000, and then you see what's the return on the investment is going to be $200,000 because rest all is the bank's money.
Yeah.
Yes, you have that liability on it, but you have the asset also along with the liability. If something goes sideways, you always have that asset which you can sell it tomorrow, and you can bail you out from that side, right? That's what most of the people don't miss. They miss it.
Yeah. And I've seen you, like, we've met so many times and talked about this. So many people miss the big picture in real estate. This is not get rich in 30 days.
It's not.
You got to look at that. And that's why we worked on it.
I keep telling people, I keep telling it, and I still keep saying it. Real estate is not for 30 days or 6 months. Yes, if you can make money in 6 months, great. You are lucky in that side. But that's not should be the goal of it. That should not be the goal of it, is making money in 6 months or 3 months.
Yeah.
So now we come to the big other side, where everybody gets freaked out. They say, the moment I say that this is the option, you have it, they say, no, we're not going to do this. We are not going to buy this, or we are not going to close the deal. It's private lending. Okay. And guys, again, don't stop watching this video when I say private lending. Hear him out. He's an expert here, and he will tell you real scenarios, how he has helped a lot of my clients and his own clients. They do high volume business, how the private lending has saved it in terms of when you're talking about construction mortgages, developments, because there's so many challenges if you go to the bank to get a development mortgage on it, especially if you are not a sophisticated seasonal developer who has a reputation of 10, 15 years, or at least have under the belt 3-4 projects. So Raghav, when we talk about private mortgage, how is it different from the banking side? A. B is, how easy is it going to be to me to qualify for, let's say I'm a small investor just buying a subdividable property. How easy it will be for me to have that?
For sure. So just talking about the first thing on how it's different from a bank.
Yes.
So the big difference with private lending is we like to call them common sense lenders.
Okay.
Right? They're focused on equity, the value of the property, and them like just being secured against the property. Right? They're not as much into seeing your last 5 years of certain history or something else, though they would like to know some details to make sure it's a good investment for you.
Yes.
And if private lending done right is beneficial both to the lender as well as the borrower, because it's not about forcing someone in a desperate situation. That's what people think it is, and that's because people have used it wrong. But if you do it right, it's like one of the best tools. It's like you can leverage it in such a beautiful way with no questions asked. It's like asking money from your parents versus your wife.
Exactly.
So much more easier to take.
So much easy to take it. But when people say, "Oh, I don't want to ask money from my parents because I'm an adult now, I'm mature enough," great. You're not borrowing the money. You are borrowing the money from the parents. You're not asking for a gift from the parents. Yeah. It's better to have it exactly as you said it from the. When I come to the point is let's see, I'm the developer.
Yeah.
Or not even a developer, you can call me. It's a single family construction. Or I'm buying a lot, which is subdivided into 7-8 lots. I have a personal experience going to the credit unions or the banks. Banks, they don't look into it. There are some credit unions who look into it. But if you're a new person, they just completely say no.
Yeah.
So I don't understand, okay, as a new person, somebody has started from somewhere and I'm new into this business. How I'm going to start it if bank's not going to give me the money? So what else option I have it as?
Absolutely.
Right?
So I'll give you an example of construction, then we can do other parts. So, a few months ago, prime was somewhere in the 2% range.
Correct.
Right? Now, a typical construction mortgage with most like credit unions was higher than prime. Some were doing it around prime or prime plus 1 or prime plus 2%.
Yes.
That was kind of the range. So you're looking at anywhere between 3 to 5%. And in some cases, those credit unions or banks charged a fee. That is like a small fee or something. That's how the situation worked. And then, of course, they had more restrictions. They wanted to see more documents and everything. So around the same time, I did some clients in Kelowna, Surrey, Kamloops who wanted construction mortgages. And for some reason, we just couldn't get it to a bank. There were just so many questions. Something didn't make sense. And we were getting a rate in private mortgage for 6.5%,
right?
Plus the the lender brokerage fees, which are regular. But paying 1.5-2% extra on a construction where the margin is at least 15%. Correct. If it's not 15%, it's not even worth doing it.
Yeah, it's not worth it. Yeah.
Then how is that not a good idea? Especially if you've acquired the land already. Yeah. It is a more short-term thing. You're probably going to be out in less than a year, and then as soon as you're finished building, refinance with a regular residential mortgage.
And what the real life scenario would be the challenges the people get it into, or the buyers who are new into this business who wanted to get into. Most of them are construction people.
Yep.
Right? Those are the people who wanted to get into building homes or subdividing it. They haven't done it before, and that's why they're getting challenged. And they're not and I can give a benefit of doubt to them also, to be very fair to them too, is they are not very sophisticated in the sense because they are not organized. They don't have in-house accountants like a big companies has. Absolutely. And their papers with the banks, which the papers they're going to have, it will take them months to all together to gather all those papers, give it to the bank, and then after 2 months, they get the answer no, because you don't have any experience. Whereas the private lending, and you have done the deals too on that, is easy to do it. You get some deals under your belt after you get the construction done, the finish of the developments, and then you can go to the conventional banking.
Yeah, absolutely.
Rather than this is what, if you can put some. Do you have any experience, like a personal example you can give it on any of the deals which you have done it as a subdividable property? How much money they have to put it in? And what are the terms of lending they can get into it, or loan to value?
I'll give a slightly different example with this because that might help a lot of clients in how they invested. So typically, I had some clients who bought like almost a 10-unit building in South Surrey.
Okay.
And then they had a rezoning to actually make it a bigger multifamily project. Right. And it's still in progress. So, the property was worth around $4 million. A credit union, even if it had good rental, they were giving them a maximum of $1.5 million. So they had an extra $2.5 million worth of equity, which they can't use. Yes. Now, these clients then found, I think, a 10-acre lot in outside Calgary for commercial property, which was a great deal where they could make so much more money. Right? They can probably get a 30 to 40% return over the years on it. Yeah. So they essentially came to me. We first looked at possible scenarios with different credit unions, but they needed the money in a month. And we got them a second mortgage, which is considered a private mortgage, with a proper exit strategy that, okay, you do these steps, this is how you can get out.
Right.
And they got, I think, 800,000 something, and they used that to close on the land, and then eventually got construction financing on the land because of the cash and the development and everything experience they were doing.
Sorry, I'm kind of cutting you in between. Is if for some people may not understand, they get confused with the numbers it's going to be. So what you're trying to say here is, I own a property where my property is already have a mortgage on it. It's a development property. I purchased it for, let's say, 5 million. I have a mortgage of 3 million on it. There's a 2 million equity on it. Can I go to the private lender and say that, give me the equity on this so that I can buy another property?
Yes, on a case-by-case basis. Just depends on
the condition obviously the conditions, but it's doable. It's not completely off where bank has said that you have maxed out. Because I know bank is not going to give you more than what the purchase of the price is. Whereas the private lenders, and some of the private lenders I have come across, definitely you have come across with more, is they go with the market value, not the purchase price. Whereas banks do is, they always play as it's going to be either going to be a market value or the purchase price, whichever is lower. Which is not fair to the buyer, is especially in this market when the prices are coming down and they purchase it for something. Let's say I purchase a property for $1 million. Tomorrow I'm closing it after 1 year. The market has gone up. The property value is 1.3 million. Bank is going to appraise it. Appraisal come 1.3, but they will still lend you on the basis of 1 million. So technically my equity after putting 20% down is going to be more than $500,000, not $200,000, $500,000. Isn't it not wise, Raghav, then I should go to the private banker and say, value is 1.3, give me 85, they do it 85 or 80%. Let's take 80% of that is going to be. I'm only putting 20% down and closing that property and then go to the bank and refinance it.
I'll actually give you a live example of this because I mean, I'm so happy for these clients. So they bought a townhouse and they got a good deal. I think they bought it for 900,000. And when the time for completion came, the value was close to 1.1 million. Now, if they go to a bank, they will only get 80%, typically 75 to 80% based on their income of the 900,000. And they had good income, good credit, everything was good, but they didn't always have, the longest history of the down payment, everything, and all that stuff, which typically happens, or some income issue, right? But so what we did was, they went to so many lenders, none of them could finance them at the market value, and they did not have the down payment. So with me, they came and I've worked with them for a long while. I got them the financing up to 85% of the purchase price. So got them more than with only 15% down, because that was lower loan to value per se, or lower financing on the market value. And they haven't made their first mortgage payment. And as soon as they got to us, they went to their bank. The bank was like, well, you've already purchased this house and the market value is higher, so now I'll finance the market value.
That's what I see. This saves the deals for it, and the people are not. They have to be creative. I would say, rather than just having one mindset. Okay, somebody told me, my uncle told me, my aunt told me, my neighbor told me, don't go to the private lenders, and that's the only reason I'm not coming in. Without even getting into deep, like how the private lender can help him. I'm not vouching here for private lender or for supporting a banks. I'm saying, whatever you want to do it, do a proper due diligence on it, do a proper homework on it. Sometimes private mortgage is going to be more benefited to you than the A, because the amount of money you have to put it in and the time is going to be both the things are very valuable, money and the time. Right. So you have to be more looking onto that side. So another point I want to say is, let's say I'm a new person, no history. How much money I have to put it down when I'm building a house, construction mortgage?
Okay, so typically so there's two scenarios: if you already own the land, or if you're buying a land. Typically, if you're buying a land with not much permits and everything in place, just land only, you need to put 40 to 50% down.
40 to 50% down.
Just on the land.
On the land only.
Yeah, but on construction costs, typically private lenders will finance 75 to 80% of the costs.
Okay, and they take the money upfront for all the monthly payments, right?
There are scenarios. So we have some flexibility. In some cases, we can do that. In some cases, we get them to pay for it. So there's different flexibility depending on what option.
And also about some scenarios I have come across is, my client has purchased a subdivided property. Let's say for 1.5 million. Sellers obviously has sold it because it is 1.5 million on the basis of it's going to be subdividable. But when I go to the bank send the appraisers. They don't care about it's a subdivided property because it's going to go into commercial lending. If it is a subdivided property, banks are going to be doing it. Okay, we will do it as a residential mortgage. But when the residential mortgage appraisal comes, always is going to come less than what it has sold.
Significantly lower.
Because the appreciation is because of that subdivision in there.
Correct.
In those scenarios, how you can come into the picture and help the client, how to get, because every client wants something is, as an investor, I want it as less mortgage down payment I have to put in.
Absolutely.
Because if I'm going on that basis, buying 1.5 million and the appraisal will come 1.3. I have to put 20% down of that. And 200 shortfall. So it's too much for me to do.
So there's two scenarios here. When it comes to subdividable properties, it depends on, is it currently just land or does it have a home on it?
Okay.
Typically in private, we can also lend on commercial.
Let's say it's a house. Most of the times it's a house on it. So let's say if we take a scenario if it has a house.
Yeah, definitely. So in that case, what we'll do is we actually call our appraisals and ask, what is the range of a residential appraisal and what is the range of a commercial appraisal.
Okay.
Right. So let's say for a scenario like this, the residential value is 1.3 million. And the commercial value might be 1.6 million.
Okay.
Now, if I go the residential route, I can maybe finance 80 to 85% of the lower value, or I can go on the commercial private side. So private, we have different specs in which it'll depend on how strong of their plan is than the covenants, but the financing might be anywhere from 60 to 75%. So they might need 25% down.
25% of the purchase price.
Of the purchase price, but we lend on the higher value.
Yeah, so for giving let's do the math here. So if I'm going to the bank and the appraisal will come 1.3, 20% of 1.3 is going to be what? 260 to 260?
20% is 260.
260 plus $200,000, which I shortfall of is because the appraisal has come now less.
So you need to pay 460.
So 460.
Yes.
If I go to a private lender, how much would be you saying it? 25%?
1.3 million?
1.5 million because the appraisal will come from, because it's going to go under commercial lending, private. So then the appraisal is going to come the same value.
Yes.
So that will be coming in
some cases, 25%.
25% going to be, we will be putting it. So that's going to be around 300 and then another 50. So 350?
Yeah.
350. So I'm still actually saving around almost $110,000 less.
Yes.
And paying in terms of interest, because interest is also be counted, how much extra interest I'm paying it.
Yes. But just so you know, in this example, sometimes if a property is meant for a commercial use, a bank may not finance it.
Oh, that I know. That's why I'm saying bank is not going to finance it because it's a subdivided. That's what I said. That's the reason the appraisal is going to come less.
No, but even if the appraisal comes in less and they know it's more for a commercial use, some cases they can't. They don't finance it.
Okay.
It's more subjective.
Yes.
But we've seen that happen.
Okay. No, that's a good thing
so,
to know.
In some cases, of course, if you get it, then great. But we've seen cases in which that they refuse to do it because it was primarily meant for a clearly commercial use. They knew the clients couldn't live there.
Yes.
So that does happen. In that case, your option is to look for other options.
Yeah.
Because even on the commercial side, like typically a commercial side at a bank right now is prime plus 1 to prime plus 2%. With the current rates, you're looking at 5.5 to 7%.
Yes.
Depending on what you're doing.
Yeah.
So
no, makes sense. And another part is going to be I see is people drop the plan to do any construction or a development if they're buying it, goes into the private lender. I tell them if you run the numbers, it still makes sense.
Yeah.
Because I'll give you an example from one of my clients. They purchased a property for $5 million. They got a private lending. In a couple of weeks, they got a private lending approved. That's how the private lending is, right? And they put only $1 million down. So the lending is of $4 million. Yeah. Yes, the lender has taken upfront the whole year payments on it. Yeah. So give or take, they put around 1.2 million.
Yeah.
Okay, for the whole year. But with that 1.2 million, they put it in. With that mortgage, the private mortgage, they got it. They could finish the product and sell it, individual lots on it. And they made almost another $1 million on it. And that's what the point is. If they have stopped there, not to go to the private lender, just because they're ending up paying $100,000 more than the bank, that's what the numbers were coming up after the interest calculations and everything. They would have never able to make the $1 million. Also.
Absolutely. So that's the big picture, right? Yes, like sometimes people think, this is costing me 20,000 or 50,000 extra, but because of that 50,000, you'll make 200,000.
Exactly. So rather than making, I would be more happy making $1 million than 1.1 million, but I'm making something.
Yeah.
Yes, if I went to the bank, I would have made 1.1 million. In terms of interest was less, but still I made $1 million. It's still a lot of money not making anything.
Absolutely.
It's anytime better than zero.
Yeah, and that's the thing, right? Like private lending may not be the option for you in every case.
Yes.
And it may not even be right for you in certain cases. But that's where, talking to someone like you or me, just for more real estate questions or for mortgage questions, is we can tell you, okay, these are the three scenarios. Option A maybe does not exist. Alternate lending, maybe this is what you're looking at. This is what you're looking at in a private. This is your expected profit. What do you want to do? And you got to look at the big picture.
Yeah, and moreover, especially in this market, today's market is still the prices of the pre-sales. Some people have purchased it 2 years back are
higher.
Still the prices, fair market value is still higher than what they have purchased it. Yeah. So guys, before you try to close those properties to the bank, if you wanted to play smart, go to the bank or what Raghav was suggesting, you go to the private lending side, because private lending is going to give you the money on the basis of fair market value, what today's market is. You will be putting less down payment. And once you complete it, and private lending, another opportunity is it's an open. There's no penalty whenever you can close it.
In most cases.
Otherwise it's a 3 months. 3 months or the worst case is structure it. Or if you tell that if the client comes to you and they say,
so they want to open,
that's why point is going to be you can close it and then you go to the bank and refinance it. It takes you another month or so. But in that whole process, you will be ending up paying pretty much no down payment because the appraisal has come so high, $200,000 higher than what you have purchased it. And that's how you save money, and that's how that gives you the opportunity to buy another property. So,
and if you remember, even yesterday when we were connecting, we were talking about that property as an investment. So the guy who was actually bought it, and we were joking about it. So like, someone got this really good oceanfront property, and they got a deal of
the one in Port Moody.
So the client got a deal of buying that for I think 900,000 or something. I forgot. And these guys are like people who invest for a living, and they work with investors, and they know the market value with 50 grand in renovations is 1.2. But they got to close in a week or 10 days, and it doesn't make sense to go through different channels. They want to do it in the company name. So they'll just put 20% down. They're coming to me. I'm giving them, probably probably an 8 to 9% annual rate, but they're only going to keep the mortgage for 3 months. There's no penalty to. So
let's rephrase this as Raghav. So it's very interesting you came up with that. I forget about this conversation we were having it yesterday. Yes.
South Surrey.
So So could you please tell them to all the viewers here or the listeners here is also about the same thing. What is actually the price without taking the names and the address of the property? What actually the price of the property was it, and how he did this?
Sure. So I'm just going to round up the prices just for simplicity. Let's say the property they're getting for is $1 million, a really good property, which is probably worth in 1.2 or 1.3 at least in the market, and with some renovations much more.
So they are buying it under value already because
the client is trying to sell it out fast. And they need to close fast.
Fast in 10 days.
And these guys are like an investor group. So they churn on properties like anything. Right? And they have liquid cash.
Right. So when you say liquid cash, how much liquid cash do they have?
They have 20 to 25%. Typically, that's what we want to aim for.
So 200 to 250.
So what they're going to do is they're coming to me. Now, they can't go to a bank because the company has no income, that income.
And moreover, the bank is not going to lend it in 10 days.
In most cases they don't. And just so many different scenarios, the value, everything, because they want to do some renovations so the condition isn't as good. So all that stuff, right? So they're coming to me. We're getting the house appraised. We're probably going to ask them to do a 200 to 250,000 down payment. After that, they'll probably put in 50,000, let's say, in renovations or improvements.
That 50,000 is also coming from their pocket.
That is coming from their pocket. So they're spending 300,000 on this. Right. Because the bank option is not there, they'll probably pay 8 to 9%, somewhere in that range of interest rate a year. So maybe let's say they're paying $2,000 or $1,500 of extra interest over a bank mortgage in private lending. So let's say that's another 10,000 in expenses. So till date they've spent 250 down, 50,000 for the renovations, and another 10,000. I'm not counting property taxes because that's in both scenarios. So they've spent 310,000, including renovations. Right. Now,
but there's a lender fee too, or let's add on the lender fee.
So there's a lender and broker fee. Totaling 2%, 1% each.
Give or take 20,000. Let's say 16,000 is.
Yes.
Too easy math. Let's take 20,000. Let's take it on the higher side.
Let's say 330,000.
So, 330. So we ended up paying.
So they've spent 330,000.
Yes.
When they sell it for 1.3, their growth, they've made another 300 grand there.
Yes.
So even after paying the expenses over the down payment, so let's say it's the fees, renovations, all that stuff, they're still going to make close to 200,000. In 3 to 6 months.
And that's what I tell the clients also sometimes. And it's not about the private lending is going to be, and just because of the private lending, they could get this. Because I don't think so any bank could do it so rapidly unless you are you're a multimillionaire and you have a lot of funds in there. You have a private banking from the other national banks, then you can. But a person like
investment property, that's tougher.
Yes, it will be tougher. So rather, and there are a lot of people who wanted, and especially in this deal, is they wanted to do a closed deal. So no, that's good, Raghav. All the information you have passed on so far is great information, and I hope people liked it. Even though if you don't want to get into that, it's fine. It's a free information there. No harm in getting that. And if you feel tomorrow that you need some quick funding, This is the gentleman sitting right there. You can reach out to him. Raghav, do you want to share your number?
Absolutely. So my company is 7 Lending. You can call us at 604-260-6900. So that's 604-260-6900.
And my information, if you wanted to reach out to me for any properties, I believe the information is going to be underneath there. No, thank you guys. So that's pretty much it for today's episode. I hope you like the information we passed on, and we will catch you next time with All Due Respect podcast. You guys have a wonderful day. Take care. All right, that's pretty much it is. Thank you guys for watching and tuning in, for putting up your valuable time, and we'll catch you next time with All Due Respect podcast with all five. Okay, I'll do one more time.
We need these bloopers, man.